Ever wondered how to make money during a recession? Knowing how to navigate market turbulence with confidence and emerge triumphant, from savvy investment strategies to shrewd decision-making, is crucial. In this video, you'll learn Warren Buffett's tips for making money during a recession as we delve into the mind of the legendary investor on his invaluable insights that have withstood the test of time. Things are starting to look up for the US economy, but not everyone is feeling the effects yet. Some people are still struggling, and there's a chance that we might have a recession on our hands. But there is a silver lining here, and here's why. When there's a recession, it means there are opportunities to make smart investments and come out stronger. And guess who's a pro at this? Warren Buffett. He's a money-making guru, super successful in the investing world, and one of the richest people on the planet, with a net worth of over $100 billion. So, what's his secret sauce? Buffett likes to find strong companies that are on sale. He looks for companies that are undervalued in the market and buys them at a bargain. Then, he holds on to them for a long time and watches his investments grow. He even says that when he's had bad news, it's a golden ticket for investors. Why? Because it means that you can buy a piece of America's future at a discounted price. Imagine getting your hands on something valuable when it's on sale. That's what he's talking about. Let's look at IBM and Microsoft. These giants were created during tough times, and now they're killing it. They started out when the company was down and the stocks were cheap. And look at them now, super successful. So, if there's a recession on the horizon, don't freak out like everyone else. Instead, take a page from Buffett's book and see it as an opportunity to grab those discounted shares and ride it out for the long term. Yeah, it can be a bit nerve-wracking when others are panicking and selling, but remember, fear can be your friend in the investing game. Buffett's advice is pretty simple to most regular folks. Build a diversified portfolio and let it do its thing without constantly meddling with it. That hands-off approach can be a winner in the long run. Warren Buffett's #1 tip for making money during a recession is to be patient and focus on long-term investments. During economic turndowns, there might be a lot of uncertainty and volatility in the markets. Buffett advises investors to stay calm, analyze potential opportunities, and invest in strong, undervalued companies that have a history of weathering economic challenges. By maintaining a long-term perspective and avoiding impulse decisions, one can position themselves to benefit from the eventual recovery and growth of the economy. Before we dive deeper, make sure to hit that like button and subscribe to this channel for more incredible, life-changing content. Now, let's move on. Let's take a look at the top tips you can implement to make more money during the recession. The first tip is to identify opportunities. During a recession, making money may seem challenging, but there are still opportunities to be found. One key tip is to identify thriving sectors even amidst the struggling economy. Keep an eye on industries like healthcare, tech, and e-commerce, as they may hold hidden gems for potential profits. It's important not to rely too much on economic predictions during uncertain times. The economy is a complex and unpredictable system, and even the experts can get it wrong. Instead of trying to predict the future, focus on adapting your strategies to the current situation and remain flexible in your approach. Number 2. Invest in productive assets. Buffett's top recommendation for investing is to put your money into productive assets. These assets include real estate, businesses that make or provide goods and services, and even farmland. The great thing about these productive assets is that they generate cash flow, giving you a steady income stream. You can reinvest that money back into your investments. The beauty of investing in productive assets is that your income isn't reliant on the ups and downs of the market. It's a more reliable source of wealth creation. According to Buffett, owning farms, real estate, or businesses can lead to significant rewards over time. All you need is patience, a calm approach, a diversified portfolio, and minimizing unnecessary transactions and fees. Number 3. Do your research. If you want to follow Buffett's advice, then it's crucial to do your homework before investing. Start by learning about the company you're interested in. Check out who's running it, what they're selling, and how they're doing it. Do you understand their product, and do you think it will be successful in the future? Next, take a look at the company's financial statements, which you can usually find on their website. Check their balance sheet, profit-loss statements, cash flow, operating costs, revenue, and expenses. Does everything look okay? Is their net profit increasing over time? Also, make sure their debt is reasonable. Don't forget to consider the broader economy and how the company compares to its competitors. Look for businesses that stand out and have growth potential, especially in competitive markets. And remember, your work doesn't end once you invest. keep yourself updated on the company and the economy because things can change, and your investment strategy should adapt accordingly. Stay informed and be ready to adjust your portfolio if needed. Doing your research and staying informed will help you make smarter investment decisions, just like Warren Buffett does. Number 4. Invest in companies with strong fundamentals. Investing in companies with strong fundamentals is a smart move, according to Buffett. Look for companies with a solid balance sheet, a reliable income stream, and a great management team. These qualities help companies withstand tough times like a recession and come out stronger afterwards. Warren Buffett's wise advice comes into play here. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. In other words, prioritize investing in excellent companies with solid fundamentals and a promising future, even if the stock's price seems fair rather than incredibly low. As Buffett puts it, if a business does well, the stock eventually follows. So, it's essential to focus on a company's underlying strength and fundamentals before investing. The S&P 500, a stock market index, has shown impressive returns of 34.39% over the past 3 years and 52.47% over the past 5 years. This just goes to show the value of thinking long-term and not panicking over short-term market fluctuations. So, stick to companies with strong fundamentals and remember to invest for the long haul. Number 5. Invest more. Investing more during a downturn might feel nerve-wracking, but Warren Buffett suggests it's a good investment strategy. The market often experiences turbulence before the economy, and stock prices may fall well before a recession hits. Even though the future might seem uncertain, these times present the best opportunity to buy more. By investing during economic slumps, you can grab quality stocks at discounted prices, potentially saving a lot of money in the long run. This strategy can be highly profitable since when the market eventually recovers, you'll enjoy significant returns on your investments. One excellent way to invest is through an S&P 500 index fund. Over the past century, it has shown an average return of about 10%, or just under 6.9% when adjusted for inflation. During the Great Recession, the S&P 500 hit a low point in March 2009, but within the next year, it saw returns of nearly 70%. Buffett's advice is to be fearful when others are greedy, and be greedy when others are fearful. So, when stock prices fall further during a recession, it's your chance to be greedy and invest as much as you can afford. If you find this video informative, like and subscribe to this channel for more educative content. Let's continue. Number 6. Focus on long-term investments. Buffett's advice is clear. Focus on long-term investments and be patient. Short-term thinking can lead to impulsive decisions, so it's better to stay committed to your investments over time. The stock market tends to go up in the long run, and those who hold on to their investments can reap rewards. Buffett even suggests buying something you'd be happy to hold for 10 years, regardless of short-term market fluctuations. Nobody can predict the recession's exact timing or duration, but we know that the economy and the stock market eventually recover. Sure, short-term ups and downs are normal, and there might be moments when the economy slows down and stock prices drop. During such times, your investments may lose value in the near future. However, even in the worst recessions, things will get better with time. So, keep your eyes on the long game. Number 7. Investing in defensive stocks is a strategy to consider during uncertain or challenging economic times. According to Buffett, defensive stocks are companies that tend to be less sensitive to fluctuations in the overall economy. They often belong to industries that provide essential goods and services that people need, regardless of the economic situation. Examples of defensive stocks include companies in sectors like healthcare, utilities, consumer staples, such as food, beverages, and household products, and some parts of the technology sector that cater to essential services. During economic turndowns or recessions, consumer spending may decrease and people might cut back on discretionary purchases. However, they usually continue to spend on necessities, which can benefit defensive stocks. These companies often have stable revenues, and their stock prices may be less volatile compared to other, more cyclical stocks. Number 8. Dollar cost averaging is an investment strategy where you regularly invest a fixed amount of money into a particular investment, regardless of the market's ups and downs. The idea is that by investing consistently over time, you can reduce the impact of market volatility on your overall investment. Here's how it works. Let's say you decide to invest $100 in a certain stock every month. If the stock price is high, your $100 will buy fewer shares. But if the stock price is low, your $100 will buy more shares. Over time, this strategy can average out the cost of your investments, so you don't have to worry about trying to time the market perfectly. Dollar cost averaging can be a great way to smooth out the effects of market fluctuations and build your investment portfolio gradually. It's especially useful for long-term investors who want to stay disciplined and not get swayed by short-term market movements. The market and the economy can be unpredictable. While there's a possibility of facing a recession, having the right strategy and making wise investments can help safeguard your money. Stay informed, stay diversified, and focus on long-term opportunities for financial success. Staying calm and making well-informed decisions will serve you well, no matter what the future holds. Don't forget to like, share, and subscribe to our channel for more insightful content. Thank you for watching.